Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Ryan Mendy on the line, and he's COO of the Edge Consulting Group. Ryan, how you doing? I guess it would be this afternoon for you.
Good to hear you, Brianna. And John, how are you doing?
We're doing well, so let's go right to it here. We did have a merger today in the by FedEx taking over. I believe it's a British company. Was that something that you had on your radar?
Yeah, well, you've got to remember also one of the activists that were involved in TNT. If you go back 5 years ago, was Jana Partners, where they were calling for UPS to take over the company, and back then the stock was trading around 10. And so it looks like it's getting taken out at just below that, but fair value. But either way, the stock's gone from dizzying heights from where it is today down into the low single digits. So anyone gotten involved in the last 5 years, it's going to make a great return. And that's what M&A ultimately does for the target companies. It doesn't do much for what we found from our study that we're just about to release with Deloitte. It doesn't do much for the acquirers.
Well, it's doing something for the FedEx stock here today. That stock was trading sharply higher. I mean, that's kind of an abnormal reaction, isn't it? Usually the acquirer takes a hit. I mean, are they looking for this thing to be immediately accretive to earnings, or why do you think they're rallying FedEx so much?
Generally, when the acquirer will go for when the acquirer does well, that's because they're getting a good. That's because they're getting a good hand out of the deal. So something like TNT, when you think about its market presence, its market share, especially in Europe, and especially in the synergies that it will have going forward, they're getting a good price. So in other words, they're getting a good deal. So what we found from a study, when the acquirer gets a good deal, that's when the acquirer's share do well in the day. Otherwise, it just looks like, and likewise also when companies are doing it in all cash deals, they're the ones that significantly outperform. But FedEx will do well today because it looks like it's very synergistic.
All right, moving on. Before we start talking about some of the new candidates out here, we just wanted your take on that Warren Buffett deal. He takes Heinz private, 2, 3 years ago, and then now the group is taking over Kraft here. I mean, what a big windfall for Warren. I mean, how many times do you think he's going to be able to pull that off?
No, well, there's someone who you wish would stay alive for another 200 years.
Okay.
Right, yeah.
Okay. All right. So let's move on to some possible spinoff candidates ripe for a takeover. And first, let's start with ADT. Give us the background on that and who could be a potential suitor.
Well, so ADT. What you got there? You got a company that's around 7 billion, spun off from Tyco back 2.5 years, 3 years ago on September 2012. I remember. So it's been here's the killer. It's been 2.5 years since it spun off. Now it's a leading provider of monitored securities. Everyone who's conscious about the house has got one of those big yellow boxes outside the front door. So it does all interactive home business automation and related monitoring services around the US and in Canada. Now the big thing here is that it's one when it comes to taxation, spin-offs, as we found from our study, they get taken out. Around 3 out of 10 spin-offs get taken out within 2 years, or taken private within 2 years of announcing. So what we're seeing in the last 2 decades we've been covering these, what we've noticed is in our study we found that companies after the 2 years, which is in the US is a tax break. Basically, you don't have to pay any tax on the deal if you take out the company after if the company gets taken out after 2 years. So with ADT's leading market positions, it's got strong recurring cash generative business model there, and it's got a huge subscriber base. Makes the company a massively attractive takeover target. So we've outlined a number of potential players that could take over it, and not only that, there's easily 30%. There's easily 30% on the upside from the shares where they are today.
And what was that dynamic you explained about after 2 years if a spinoff gets taken out, the tax dynamic?
Absolutely. So what you have is you have the IRS. What they don't want you doing is breaking up the company, and it's because ultimately it's like a sell, should I say? And that's not, and then if you dispose of a business, you sell it, you get taxed. Right. So therefore, what happens with a spin-off, because it's a divestiture, what you're doing is you're going to have, because you've got forced buyers and sellers. Say ADT at this size, if it was done today, it would stay in the S&P 500. But let's say it was like 3 billion of Tyco, it would get kicked out of the S&P 500. Thus, if you had say 30% index holders, it would have forced selling take place. Around 30% of the shares would have to get sold, whether you like it or not, tomorrow morning. So what ends up happening is that the IRS say, look, fine, look, we're gonna treat this different from a sale. You're gonna keep around 2/3 or more of the exact same shareholders, like for like, when the company split up and listed. You have different management, you have different accounting. So what they give respect to that to do is say, look, okay, well, if you're to prove there's no strategy, why don't we have a medium term view that if the company doesn't get taken over within 2 years, for at least another 2 years. Therefore, we're going to treat this as tax-free. So it's like a tax distribution of shares of the parent company of another entity within the business, placed out to shareholders who want to go long term on the company, and therefore it creates stability. So therefore, it's evidently different from the black and white factor that happens with regards to a sale of a business.
Right, and so we're talking about ADT being a potential takeover target. Who are some of the candidates that you see as might wanting to take over this company?
Well, it's a very good question, and of the companies that we've got out there, one of the things that I'll have to hold back is just for the just because of the research is got its priority to clients at the moment. But we've got there's a natural fit by a couple of players out there. We've listed 7. But if you wanted to take a look at a couple of them, then one of them would be, for instance, Comcast Corp, and another would be, for instance, Time Warner Cable.
Yeah, let's take a look at those and why you think those might be a good fit for taking over this company.
Definitely. So you've got with Comcast, it delivers media and television broadcast services worldwide. 150 billion cap, sales are 70 billion. Now the issue there is it's got a market leadership position, and it's got a product bundling opportunity with regards to ADT, and furthermore, it's got the lead across in the synergies that lay out there, similar to that as Time Warner Cable. But I would just have to hold that back just for clients on that. But there are 7 key players that could potentially take out ADT, and it's had a huge mishap over the last couple of years with the operation. So what that presents is a great opportunity, because if you look back over the last 800 companies that have broken up over the last 15 years, all those that have fallen off on average by a third of the companies have fallen off by an average of 20% in year one. And it's those companies that have seen the largest amount of takeouts within the next 1 to 2 years from their bottom, thus creating a massive premium for the shareholders.
Okay, so I want to move on to a really interesting retail takeover possibility that you also have in this report. Land's End. I mean, they have swimwear, kind of activewear, retail brand focused on people who are interested in, outdoors and being active. What makes you see this as a potential takeover target?
LE is an attractive takeover target. It's an established brand. What do we know about it? It's iconic as well. It's large. It's got a large customer base of affluent, college-educated, professional, and if you will, style conscious. I'll keep myself out of that one. Style conscious men and women, and it's got a large geographical reach. So, in our view, the stock's got a huge potential upside on the to the tune of nearly 50% on a takeover scenario, as it stands today.
And some of the potential takeover candidates that you have listed here are really interesting. I mean, Urban Outfitters, a teen retailer that's been struggling lately. Gap, it was
Mhm.
really powerful in like the 90s and early 2000s, has been struggling to get back ever since then. And then like PVH Corp, which already has gigantic brands like Calvin Klein, Tommy Hilfiger.
Yeah.
Which ones of these kind of stick out as the most probable ones?
I'd say likelihood of I would say potentially Nordstrom, Gap,
Okay.
or fast retailing.
Okay. Tell us a little bit more about why you think that might be a strategic move for any of those three.
For Nordstrom, easily for it's got as you mentioned, it's got a huge luxury product
Absolutely.
position in the market, and ultimately that would help it consolidate that position, especially with the crossover to Land's End's consumer base. Um, Gap, Gap, with regards to this, you know, you've got a global retailer of apparel here, accessories, personal care products for men and women. But it has been going relatively sideways as regards to its growth and the business, so it's had to go through a lot of restructuring. So it's got but then taken into that, it's got a market leadership position, so another one that would help it secure on its platform where it is. And then fast retailing. If anything, it's a Japanese retailer, and we're seeing a number. You would have seen Sharp over the weekend get announced for doing a spin-off. There's going to be a huge amount more. Dan Loeb going after Sony, one of our predicted spin-offs from a few years back. With regards to bringing it back to Land's End, it's with regards to the strategic growth, and it would be a fantastic acquisition for the company to make. And speaking to a number of clients who know who are global big billion-dollar funds, this is one of the read acrosses that they personally also think is a strong candidate for looking at Land's End.
We've got a couple minutes left with you here, Ryan, so I'd love to move into the media space. The last candidate I was looking at as a possible takeover target you have is Time Inc. I feel like there's already been so much consolidation in the media industry. I was really intrigued to see this as a potential takeover target, and some of the possible suitors you have listed are Meredith Corp and Gannett Co. And Gannett is just massive. We have a local Gannett paper here in the Detroit area. The Detroit Free Press is owned by Gannett Company. So I'm interested to hear a little bit of your thoughts on this one.
Yeah, so the stock's trading at a huge discount. Looks very attractive at current levels. Investors should definitely take a look at this. Take a look and a position as well for a potential upside of nearly 30%. With why in this case here, that with a wide consumer reach portfolio of iconic titles, it's got increasing digital media revenues and expected consolidation in the industry. It makes Time an attractive acquisition target for traditional publishing companies. And ultimately, more than anything, again, remember I said about the 2-year rule thing? This spun off from Time Warner back in June of 2014. We think if you want to look for it's in trouble, and not only that, over the last year, it's got to get up its advertising revenues and subscription circulation, but moreover, this as far as we're concerned, this will be taken out, and then this will be either merged with or taken out in the next 12 months.
Oh, wow, that's a pretty short timeline as far as the takeover. Oh, if it's spun out from Time Warner, I'm curious as to why they wouldn't want to take it back. Does it just not seem to be part of their business strategy, or is it more profitable for them to keep it that way?
Well, I think there would have been the key reason for him breaking up was the lack of synergies and time. What they wanted to do back from when they spun off, you remember AOL. Got the head of Google coming over to run, Armstrong to run up the sales there as well. Likewise, when they broke up TWC, you remember back in '09. The reason why they break these companies, the reason why Time did this, Time Warner doesn't want Time Inc. There's a lot of people who think Time Inc. won't exist as it does today in 5 years' time. Just purely on the basis that who wants a publishing business anymore. But as you're seeing more and more, the talking of with Land's End and the educated and the middle class who want a hard copy piece of paper to read from text. That's where there's a future for publishing businesses. And so Time Warner won't want it back. Answering your question, Time Inc. There's synergies for it to be hooked up with other businesses. The publishing businesses, the pure play peer group, that's gonna have to consolidate. The costs are too high and the profits are too low, but the brand and the reach and the market scale is huge on its potential, and it's got authority. So therein lies the reason as to why Time Inc. is it's gone absolutely sideways with regards to its share price for the last year. But yet the assets are fantastically attractive for people for one of the other players out there to take out.
Great point, and overall intriguing in observations about the media industry. Ryan Mendy, COO of the Edge Consulting Group. Ryan, thank you so much for joining us today. We really appreciate it.
Pleasure. Speak again soon. Take care. Bye-bye.
Thanks.